Good thing. It's on mute, so I'm told. Okay, try that again. Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Tuesday, March 28th. We have Brent crude oil trading a little bit down, ultimately little change, one would say, when you're only off 0.25% after such a big jump yesterday. We felt that we would start the week. Would we start it like we had started the last few weeks in the dark clouds of a banking crisis, or would we not? It seems we're not. Let's go to Vanda Nahari, founder and CEO of Vanda Insights. Vanda, your newsletter, Vanda Insights, ended the week last week very much where the mood was. Lingering fear of banking crisis continues to weigh on crude. Has that now gone, lifted? That damp, wet blanket of uncertainty of the bank crisis now lifted, and the market is returning to its comfort zone above $80 a barrel?
Good morning, Sean, and to everyone else on this panel and tuning in. Great question. Look, I think the panic, the word that we used for the first fortnight of the banking crisis, quite rightly so, to describe the environment in the markets, I think the panic has subsided. That said, I think a lot of people in the markets are probably going to be continuing to sit on the edge of their seats, because this is a kind of situation where you really don't know where the next brick is going to fall. So can you rest easy that yes, everything is fine? Regulators and political leaders are fully determined. They will backstop the next domino to fall. You don't know. You basically don't know. What one can say about oil is, I think on the fundamentals front, it has become almost a bit boring. There are no signals coming from the fundamentals front. I think that is probably happily for major consuming countries and perhaps even producers, not so much for traders, because there isn't really much excitement happening. Nothing, not much on the physical trade, and certainly not on the speculative front. So in the absence of anything major changing on the fundamentals front, oil sentiment will remain tight at the hip with the financial markets. And within that, of course, I think the banking crisis is the latest one to hit folks between the years. And I think that will remain so for the next few. It'll be hard to call a complete stop anytime soon to this turmoil.
Let's go to China, because that's really where the answers to everything this year supposedly are, at least when it comes to oil demand recovery. Victor Yang, senior analyst at JLC Network Technology. Victor, we're now at the end of the first quarter. If we reflect on the first quarter after COVID has been lifted, the COVID restrictions lifted in China, how much of a recovery have we seen so far in Q1?
Yes, hello. Good morning, Sean.
Good morning, Victor.
Yeah, and we are seeing modest recovery, I would say. And we can say from Sinopec's annual report for 2022, which was released yesterday, and we can see the giant's forecast for oil demand in 2023. It expects to raise its output, its crude throughput by 3.2% this year, and its oil product output by 7.7%. I mean, gasoline, diesel, and jet fuel by 7.7% this year. So the oil giant also expects domestic demand to grow by over 7% for the whole year. And we can base on this and make some judgments. And for the first quarter, it recovered quite fast in January, and then in the first half of February, because of much more travel during the Chinese New Year. We had the peak travel rush for the Spring Festival. But in the second half of February, gasoline demand and jet fuel demand shrank a little bit because of less travel. But then it recovered slightly again in late March as travel is now coming back again. But for diesel, demand is picking up, has been picking up since, say, February, but not very fast, just modestly. And well, if you are looking at crude oil imports, we saw that from GACC data, imports in January and February declined. But actually, it was probably because of the delay unloading and customs declaration of quite a few cargoes in the first 2 months. And we might see a jump in March imports indicated by the customs data.
The recovery in domestic travel, we have not yet seen the opening, although there's been some signals of opening to foreign travel, foreign visas for tourist visas and such things. Should we expect that this will give a big lift to aviation fuel demand in China in the second quarter?
Yes. And as for international flights, it has not recovered to, say, about 60% of the pre-pandemic level yet. So we expect it to grow to about 70 to 80% of the pre-pandemic level in a couple of months. And the country is now trying to speed up this process and make easier for more people to come to China. As we had a discussion with Vandana earlier, she said that her friend told her that a lot of people were waiting for visas to come to China. So this is kind of common now. We're expecting more travels into China in the near term.
Dr. Aman Nasri, Managing Director, Middle East at FGE Dubai. Dr. Aman, one thing we haven't seen this demand recovery in China, this economic recovery in China yet, is really trigger a demand for LNG and for gas. We're seeing all over the world, while oil prices are moderating slightly, gas has collapsed compared to what were last year. What is FACT's outlook for gas and LNG demand in Asia through the second quarter and beyond?
We expect this year China as a main consumer, main importer of incremental volumes of LNG supply over the past few years to return back to the scene as it kind of was absent, especially last year when the prices went through the roof and Europe was basically sucking in every potential spot volumes in the market. This year, with the recovery of demand and economic activity and everything that Victor and you and Dana have already touched on, in China will bring basically LNG demand back to China. However, we don't think that it will be at the full scale. It still requires to compete with Europe, who filled up their inventories, their storages with Russian gas last year, but they still have to basically pull as many LNG spot cargoes into Europe this year as they can. But it will be basically kind of competition between China and Europe. In terms of total demand, we see basically the Asia demand to grow this year on year, but again, it will be not at its full scale because of the strong competition, and the market will remain tight. The market will remain tight and short of supply until the first Qatari expansion trains basically come in 2026 and thereafter, when the market will see some relief, and basically there will be a few years of balance to long before again the natural demand growth catch up. So currently we're not in a natural demand environment. There is still gas to oil switching, which has released some gas to go to Europe. That will come back, and then we have some organic demand growth in gas. That's all possible when this pressure on the LNG market is relieved after the new supply trains join the market.
Vandana, the recent wobble in oil prices, where we saw Brent drop from its sort of comfort zone of $80 to $85 a barrel through much of Q1 down to 70 to 75, and now seems to be breaking back upwards. Ultimately, this was a concern about demand destruction, the banking crisis killing off economic growth, and with it demand for energy and oil. And now that, so it wasn't a supply concern issue, and that's my point of my question to you. With Russia and its supposed 500,000 barrels a day cut that was announced earlier in the quarter, that seems to have had little effect on the market. It seems that Russian oil is still flowing, and a significant headline over the last few days: India was the biggest buyer of seaborne Urals oil in March. And the country's demand for Russian oil continues to hit very high levels. And the Russians, of course, desperate to meet that opportunity. No change there, really.
No, indeed. And, you know, when we started this year, Sean, really there were two main elements to the overall sentiment with regard to the oil complex going into 2023. So on the fundamentals front, the two main areas that to watch, and the ones that really were, I would say, the oil bulls were focused on, was a demand rebound in China, happening sooner rather than later. And of course, potential disruption, or significant, at least, disruption of Russian oil supply as a result of Western sanctions. We had already passed through the December 5 sanctions against crude imports by the EU, and it hadn't really rattled anything, but the Feb 5 ban on products was yet to come. Now, fast forward to now, I think the market is quite sanguine, reassured that Russian oil supplies are by and large continuing to flow into the market to the extent the market requires Russian oil. So exactly as you point out, you know, crude flows have been pretty healthy, very similar to what they were this time last year. India and China, by my reckoning, collectively bought about 3.5 million barrels per day of Russian crude in February, which was about 1.5 million barrels per day more than February of 2022. And that 1.5 million barrels per day increment is exactly what India has stepped in to buy. Russian refined product exports are very much continuing to flow into the markets. I'm told, in fact, in your neck of the woods, Sean, quite a bit of oil coming there. Again, from sources, I don't have firsthand information of this, but it's being relabeled and marketed back even into Europe. So long story short, and I think Bloomberg had a story this week that Russian diesel exports are at an all-time high of 1.5 million barrels per day. So no shortages anywhere.
And now we're coming into maintenance season in Russia, so there might be more crude for export if India can take it.
Yeah, look, I had said late last year that, you know, I had my doubts on how much more Russian crude India could import, and at the time it had already crept up to 1 or just over 1 million barrels per day. But lo and behold, India has continued to take more and more. So, so yes, I mean, I guess that barrier has yet to be tested as to how much more China and India can absorb, and Turkey is taking some, I think, but really these are the only two countries that Russia has to depend on. But from all accounts, Sean, the market is quite satisfied with the current supply. I think the 500,000 barrels per day, the market has moved past that. It has even been a bit dismissive of that. It might have been even, Novak and Russia trying to jawbone prices a little higher, flex their muscles a little bit. Look, we are not happy with the sanctions and so on. But really, there is enough supply in the market. That's what we are hearing in terms of fundamentals.
Victor, I wanted to get your opinion on the comments published today out of China by the Premier Li Qiang, who told foreign business executives, including the head of Apple, Tim Cook, that the country will open up further. Coming out of COVID, there was concerns, and there still is significant concerns about, as they say, having all your eggs in one basket, i.e. that you have all your manufacturing in China. Like, for example, Apple moved a significant, or is looking to move a significant amount of production of iPhones to India. Other manufacturers are looking to diversify their exposure to China. We also had the sort of what seemed to be a restriction on technology companies in China, and the most famous CEO, Jack Ma, returning to China, it would appear yesterday, for the first time in many months. Perhaps you can tell us, or from your opinion, what does this all mean? What are the signals that should be read in these developments?
Well, when China said China would open up further, it means, well, it's trying to create a better environment for foreign companies too, as well as domestic private companies, trying to create a level playing field for all the companies playing in this market, and provide foreign companies with more, well, facilities, more convenience to enable them to do better in the Chinese market. And as you said, some companies are actually moving away from China, but some are moving into China too. And some are moving away from China in the past 3 years because of the COVID restrictions and because of the cost. They are finding a place with lower cost, but some other cannot move away from China. Most of them cannot move away from China just for the cost, no. And for some companies, well, because of the US, they require some companies not to do business with China-based companies. So some of them had to move away from China because of this decoupling of the USA. And there is this reason too. And for the Chinese government is trying to make it more attractive for all the companies, not just foreign companies, but also domestic private companies, including small and micro companies. Say yesterday, the government announced a plan for tax cuts, which will amount to 480 billion yuan. That's about
that. Did you say tax cuts?
Yes.
Tax
for small,
cuts.
Yes, for not just small and micro private companies, and also in some other sectors such as R&D researchers, or R&D and high-tech manufacturing, and some other sectors too. That's about $70 billion per year, and it's trying to make it easier for small private companies to get along this year, because they're still facing quite a lot of difficulties. Yes.
Iman, I wanted to ask you to speak to the comments that Vandana was making there about reports of Russian products ending up in the Gulf and maybe in different parts of the region. You were at the recent FUJICON conference in Fujairah. Any insights to share about how Russian crude and products are coming into the Middle East?
Yes, certainly. I'll make a comment about that, but just very quickly, I want to mention, also build on what Vandana mentioned about the Russian crude production and Novak's comment. I want to say that basically, and tie it back to what you said, Sean, about the maintenance season coming up, or the heavy maintenance schedule. plans for Russian refineries. I think what's going to happen is that basically the impact of that extension of crude production, 500 kbd cut from Russia, will transfer and be felt in products. Hence, basically, that refinery maintenance is almost equally to the amount of crude production cut, 500 kbd. Hence, what's going to happen is that Russia, which is also under pressure for post-February deadline to find alternative buyers for some of its products and diesel, will have some time to build that new market, new buyers for their products. And that's basically, we expect to see the crude exports out of Russia to remain flat until that period of refining, which is basically now officially until end of second quarter or sometime in third quarter, to extend. And then either they will decide to keep to recover, which we think will happen, the crude production up when the refining capacity comes, or they will make another decision depending on development of their market. I also before coming to this, wanted to mention, Sean, that this is a 500 kbd kind of weight on the market.
Sorry.
So, sorry, the Russian production cut is a 500 kbd kind of weight. There is another.
It's supposedly so. I mean, is that tangible? Is it identifiable that cut has actually been made?
I think it is tangible, and estimates looking at their, it depends on your on one's assessment of refining, because it's basically it's a balancing act, and refining, you have to have a good estimate on demand, because what comes out is somehow measurable through all these different ship tracking and pipeline utilization. But I think that has started to that has happened, but again, it's going to transfer into product from crude. So basically the crude exports remain flat, but then the products will drop for a few months before the refineries come back. There are two other 500 kbd same size weights on the market. One emerged this weekend with KRG exports to Ceyhan out. How long that is going to stay out of the market, that's another 500 kbd, is a big question.
That 500,000 of Iraqi Kurdish oil, which is now not going out through its normal export route from Kurdistan to Turkey, and it cannot go out through the Gulf, because there's no pipeline that connects from Kurdistan to the Iraqi main system. So it remains, it's locked in for now.
It's locked in. The operators have said that we continue to produce and fill up the tanks, but some of them has already started to say that we have to shut in because of the constraint on the tanks. It depends if it goes for days, let's say, that's one scenario. If it goes for weeks, another, and I don't think it will go for months. But we have had that problem of dispute between Baghdad and Erbil a few years back. I think it was in 2014, before the ISIS attack, that they had a dispute and they kind of shut in that whole exports. But this time it's different. We think it will be a matter of days, and maximum maybe a couple of weeks, but that's a 500 kbd, and that's perhaps why the prices, as you mentioned, Sean, in the very beginning, have jumped in response. But then also there's another 500 kbd. Again, it's funny that these uncertainties or these factors, which is the SPR, US SPR refilling, and that 180
which is not
million,
happening.
Which is not happening. So this is a plus, basically, put back to the market. So if people had built in 500,000 barrels per day for the second half of this year to build 180 million SPR, now it's back to the supply market. So there are these elements, especially can potentially, if they add together, for example, a 1.5 million barrels per day uncertainty in total supply. But coming back to your question,
we'll come back to that question next time around. Let's go to the survey question, because when all is said and done, what has just been shared by Aman, maybe with the banking crisis the dark clouds of the banking crisis have now passed, and Brent will return to its Q1 comfort zone of just over $80 by the end of this week. Do you agree or disagree? After all said and done, the drama, the 500,000 up and the 500,000 down, it's the balance at the end of the day. There's no great shortage of oil in this market, so the comfort zone of low 80s will return. Agree or disagree with that? Vandana, I'd welcome your sort of insights on that. I mean, this supposedly is a market, a year of two halves. The first half was always forecast to be, supply plenty. The second half, the opposite. Are we still on that same narrative, even without putting, now that, let's say, the drama of the banking crisis is starting to recede?
I don't know about two halves, Sean. It seems like the recession is always 6 months away, and the Chinese demand rebound is always 6 months away as well. So really don't know about that. On your survey question, I voted disagree after a bit of a pause. Look, I think Brent could, it's not that far from 80 right now.
Exactly.
It could climb back towards 80, even above 80. By the end of this week, I'm not so sure. As I mentioned in my very first answer, I think this shadow of the banking crisis, I think the fear is very, very deep rooted. I think the markets are just very nervous. We are just still coming out of the COVID hit to economies. Inflation is still bad. And, we've heard from Victor as well. And, China people aren't really exactly ready to splurge yet. The Merck CEO said yesterday in Beijing that the Chinese population is still stunned, is the word he used, from what's happened over the past 3 years. So, yeah, I mean, I don't know if demand is sort of ready to rebound. All said and done, what that tells me is perhaps the new comfort zone is something like 75 to 85 for Brent. But all said and done, I think overall, I'll go back to my original theme as well. I think the oil market has become a bit boring. We've seen speculators flee over the past few weeks. The net speculative bets on crude prices rising have been are the lowest in more than 10 years. Can you imagine? Even below where they were at the height of COVID. The open interest has crept back up from 8-year lows of last year, but again, it's low compared to what it was in the recent past. So, basically, it's not a very exciting market right now. We'll probably see 75 to 85 sort of range, which is the new middling range, perhaps, for crude.
Victor, I wanted to get your insights on firstly, the two things. One being the visit of President Xi to Russia last week. Obviously got a lot of international coverage. In China, how was it seen? Was this a visit about energy supply? Was it a visit about China being a global peacemaker? How was it communicated in China? How was it seen from your perspective, the visit to Russia?
Well, the visit to Russia, well, to many Chinese, was just basically an average one, I would say. And it's, of course, for deeper cooperation to strengthen the cooperation between Russia and China. It could be also for the energy cooperation. And of course, China has been trying to negotiate, make the two countries reach a peace deal, Russia and Ukraine. That would benefit the whole world, not just Russia and Ukraine. And it has been trying to do that.
But from China's point of view, I mean, just from a perspective, there's no doubt, of course, peace in Ukraine would be a big deal. But I'm just saying, in terms of in China, in the newspapers, in the coverage of this visit to Russia, was it a story about trade and more new energy supply, or was it a story about global peacemaking?
Well, there is no specific tone about this travel to Russia, I mean, for most Chinese people. And if we look at the official reports, is about, for deeper cooperation, it's not specifically for energy. It's just kind of, friendly visit to Russia for broader cooperation. So it's kind of regular visits. I mean, for most.
And are we seeing, we're seeing, obviously, we were talking earlier about India's oil imports of Russian crude growing and sustaining. And is China the same? What's the outlook for China's imports of Russian crude oil? How was it in Q1? What does it look like for Q2?
Well, in the first 2 months, crude from Russia accounted for about 80.7%. That's a record high.
80?
No, I mean accounted for 18.7%. 18.7, almost 19%
of total imports.
Yeah, and that's quite that's quite high, and it overtook Saudi Arabia again in the first 2 months. And if we still have the discounts on Russian crude, we can see still quite large imports from Russia, and the share of Russian crude will stay quite high, may come close to 20%. Yes.
Okay, Iman, let's get that the last word to you with the survey result. We were going to talk about Russian crude products coming into the Middle East and what are the dynamics of that.
Yeah, well, on the survey question, I'm with Vandana that I tend to agree, but there are other good reasons to disagree. So it's kind of you could justify yourself, or you could convince yourself on either side.
Well, I purposely put it in this week just to force that kind of. Anything more, you can kind of wander along, but this week is this cloud lifted? Really, is the question. Yes. But it's just to quickly, man, we're out of time, but on the piece of Russian oil and oil products coming into the Middle East.
Yeah, what we saw Russian products basically rapidly increasing when the war began, and it first all came to the UAE with fuel oil and naphtha, but eventually now increasing volumes are going to Saudi, and slowly other countries are biting in. So basically last month in February, it came close to 500 kbd of products, up from historically less than 100 kbd. So that's a massive increase in volumes coming. And we think this summer, with increasing seasonal demand for fuel oil, for example, for power generation, and now with gas oil also, which is something that the region trades in and out, we see even more of those products coming. So yeah, Fujairah has seen a lot of traffic, but now increasingly some of the Saudi ports are receiving volumes from Russia, and again, that's in exchange because they have always been trading in and out of products, but that will facilitate the market dealing with this reshuffling of trade. And Middle East is certainly taking its part. Turkey is the second and next neighboring country and to Russia, which is also facilitating big time, and we expect that role to increase in the coming weeks and months, especially dealing with the gas oil, which is perhaps the largest problem that Russia has when it comes to products trade.
Okay, well, we're going to have to leave it there. We've got Brent oil trading a little bit down, so nearly unidentifiable how small the change of today is after yesterday's big recovery. The question is, will we see this relief rally that on the back of the somewhat fading banking crisis, if indeed that is what you can call it? A lot of enthusiasm in the equity markets yesterday. If that continues through today and then the week, I think $80 breaking it again, hence the question, I suppose, is quite tangible, if indeed the euphoria of the kind of relief rally in the equity markets continue. We'll wait to see. Thank you so much, Vandana, as always, from Singapore. Great to have your insights and Vanda insights. Well worth a read, everybody, every week. Iman Nasri in Dubai and Victor Yang, of course, in China. Really great to have your insights, Victor, at the end of the first quarter. Slow but steady recovery in China, it seems to be the headline out of Q1. Thank you, everybody. We'll catch up every day, 10:30 UAE time. All the best.
Thank you.
Thank you.